This roadshow is brought to you by ResearchBytes.com.
Denim Limited. Today we have with us Mr. Deepak Chiripal. He is the promoter and CEO for the company. And we have Mr. Govind Sharda, who is the President Finance. Without any further delay, I would like to invite Mr. Govind Sharda on the dais to have his comments and have a presentation on the company. Over to you, sir.
Thanks, Amit. Very good afternoon, ladies and gentlemen. This is the maiden analyst meet for Nandan Denim. The Lord Indra has been very kind for no rains in Mumbai for the day, and I hope we have a very interactive session for the day. Friends, Nandan Denim is predominantly a denim manufacturing company. Denim today is a very commonly used fabric, originally invented in Italy, commonly practiced in the US, and finally perfected in the subcontinent of India and China. Today, China is the largest manufacturer of denim in the world, followed by India, Latin Americas. Denim is predominantly a cotton fabric, and therefore the composition and the country or the economy that controls cotton plays a very significant role in controlling the denim industry. We are fortunate for the second consecutive year, India is going to be the biggest producer of cotton in the world. The global denim market size is estimated around $17 billion, of which around 70% is accounted for by Asia. The Indian denim apparel market is growing in the range 15% to 18% for the last 10 years, whereas the global denim market is growing at around 3 to 5%. As of today, India is controlling around 10% of the global denim market, and to create a very specific perspective, Nandan Denim is controlling around 10% of the Indian market. So essentially, Nandan Denim is controlling around 1% of the global market. India is the fourth largest denim fabric exporter of the world, though we are the second largest manufacturer of denim, because next to China we have Pakistan and Turkey in the list. India was always having a disadvantage up till 2 years back when it came to the cost of the manufacturing and the continuous depreciation of dollar. Over the period of the last 2 years, India has got some advantage in manufacturing, and the currency has also depreciated dramatically to make India a very valued manufacturer of denim fabric. And of course, the Indian government's textile upgradation fund scheme, coupled with the state government's scheme, 4 of the Indian states have come out with the specific schemes in the state of Gujarat, Maharashtra, Rajasthan and MP. All those schemes put together are making Indian textiles located in these 4 states very competitive vis-a-vis the international manufacturers. If you look at the denim industry, the way it is behaving in India, we have a currently installed capacity of around 1.2 billion meters. Against the installed capacity of around 1.2 billion meters, a theoretical possible production is around 1 billion meter. The domestic consumption is around 700 to 800 million meters, and 200 to 300 million meters is being exported. If you look at the pattern, generally there is say that denim is not moving up in the organized sector or the unbranded sector. Every denim jeans that we buy, denim is predominantly being used in the jeans manufacturing. Of course, the other applications like bags and the jackets are also there. Almost all the products that we buy made of the denim are, in a way, are branded. The brand need not be international. It could be a regional player, it could be a local player as well. Because getting a denim fabric converted into a jeans requires very specialized effort. A common tailor in the nooks and corners will find it very difficult to convert it into the jeans. If you look at the jeans popularity in the international scenario and in the Indian context, the per capita consumption of jeans pair in India is around 0.3. And if we compare it with the US and the UK data, the data is around 8 to 9 pairs. There is a lot of roads to be covered by the Indian economy when it comes to the jeans consumption. If we compare with another sizably populated country, China, the per capita consumption is around 2. India can expect that we could be hitting a per capita consumption of around 1 in next 2 to 3 years time. If you look at the current statistics available as far as the manufacturing capacities and the utilizations are concerned, essentially it requires India needs to double up its manufacturing capacity over the period of next 3 to 4 years' time. Nandan Denim has undertaken an expansion program. Post completion of that expansion program, we will have an installed capacity of 110 million meters. Post completion of the expansion, Nandan Denim would become fourth largest producer of denim in the world and the biggest in India. If we look at the scenario, the way it would be behaving post expansion, Arvind and Nandan would be almost neck to neck, followed by RV Denim with around 85 million meters capacity, Sudarshan Jeans and like players. So we would be numero uno, and it gives us a sense of confidence, a sense of achievement. 10 years back when Nandan was established, we started with a manufacturing capacity of around 6 million meters per annum. The way the sales has progressed over the period of last 1 decade, last year we recorded 72 million meters sale. The sales that we accounted for in the first year has been achieved by us in a month's time. It's a great moment for us that we have done wonders in the period of last 10 years. The Indian denim market, sir, we have a seat over here. You can be. The current domestic growth is around 18% and international market is growing at around 3 to 5%. Going by this rate, assuming there is no superlative growth coming in the picture, India needs a manufacturing capacity of around 2 billion meters. Currently, we have around 32 to 33 manufacturers operational in the denim manufacturing with a rated capacity of around 10 to 110 million meters as the rated capacity. Top 3, namely Nandan, Arvind and RV, are controlling almost 1/3 of the manufacturing capacities in the country. Denim fabric generally is available in the price range of rupees 80 per meter to rupees 300 per meter. If we look at the pricing point and the quantity availability, the lower the price is, the higher the competition is, and of course the higher the market size is. But with the increasing disposable income at our end, the dynamics are changing, and gradually there is a shift happening in the customer demand towards mid-range segment. Another demographic fact, 7% of the Indian population, which is located in the 10 major towns of the country, they account for almost 50% of the denim consumption in the country. 93% of the Indian population is accounting for the balance 50%. If we look at the gender bias, 85% of the denim consumption is happening in the male segment, 15% is commanded by the women segment and the kids segment, and e-commerce has just arrived in India. This certainly poses a question, are we really having overcapacity in the denim sector? If we look at it from the Nandan's perspective, our experience is starting from 6 million meters in FY5, reaching to 110 million meters in FY16, we have never had our machines waiting for the orders. We have never ended with the higher inventories. We never defaulted to any of the lenders. Profits could have fluctuated, particularly in the initial stage when the company entered into the manufacturing operations, but never disappeared. The company never faced any problem for financing of its expansion. We have been a vigilant player in the sector. We have understood and we have shared it with you as well. The lower the pricing point is, the higher the competition is. Company realized it some 3 years back when we undertook an expansion project which is underway, and it has already started distancing itself from the low end product. Cotton is the basic raw material for manufacturing of the denim. Cotton plays an important role when it comes to the pricing of the denim fabric. Sir, we have one seat available over here. Yarn prices normally move in tandem with the cotton prices, and any impact on yarn prices has a cascading effect on the fabric. If we really look at the value chain, particularly in the cotton segment, we have the fiber generation, we call it ginning. Then we have the spinning, After spinning, there is a weaving. Post weaving, we have the processing, dyeing and finishing part. And then it goes to the makeup, which is the garment manufacturing, and then it goes to the retailing. Nandan is present in the first 4 stages of the value chain. Right now, we are not present in the makeup segment and the retailing segment. The away you are from the basic cotton, cotton is available at the fiber stage in the presentation. The higher is the insulation available. Of late, cotton industry has moved at the whims and fancies of the Chinese behavior. If you look at the Chinese cotton stocking policy, right now China is controlling around 58% of the global stocks. The stock is accumulated some 4 years back, and the Chinese government is in a very catch-22 type of situation. They have one option: they can release the inventory available with them. If they release the inventory, the global demand for the cotton would decline, the international prices of cotton will decline. That will make Chinese economy incompetitive when it comes to the export segment. And if they do not release it, then imports increase, international prices increase, and in turn, China again becomes uncompetitive. The way the Chinese economy had behaved in the recent past, they have entered into an arrangement with the WTO that they will be declaring around 5.2 million bales quota for import in the Chinese economy. Look at the number. Last year they had imported around 9 million bales from India alone. Chinese cotton consumption, after a gap of almost 4 years, has gone up. A dramatic shift of the consumption pattern brought in basically by change in the subsidy scheme used by the Chinese economy. Instead of giving subsidy to the distribution agencies, they have started giving subsidies directly to the farmers. And in turn, it has created a demand for cotton, because now the cotton, the way of the subsidy is the market price minus the reserve price of 19,200 yuan, the gap would be paid directly to the farmer. But then they have again differentiated. 50% of the Chinese cotton is generated in the Xinjiang, where they are giving the differential loss to the farmers, and for the rest of the Chinese part, they are giving a subsidy of 2,000 yuans. If we look at the global scenario of cotton, worldwide in the textile sector, 65% of the market is dominated by the man-made fiber and 35% is only accounted for by cotton. Recent movement in the crude prices has also forced for the cotton prices to go down, because cotton cannot keep on moving up when the crude prices are going down, which are having a cascading effect on the man-made fiber. Generally speaking, there are very limited triggers available for the cotton prices to go up. If you look at the current statistics available based upon the USDA sharing, the global cotton production is expected to decline by around 5.2%, while the cotton consumption is expected to go by 4.5%. The cotton consumption is going up because the prices are going down. There is a simple demand and supply rule is applicable, and it is predominantly being led by the Chinese consumption. The cotton production is expected to decline due to decline in the acreage and the continued lower yield in the Indian continent. The increase in the cotton consumption is expected to be driven mainly by China on account of decline in the cotton prices, which has improved the competitiveness of cotton yarn with respect to the synthetic fiber. Coming to the Indian cotton scenario, we expect the production to shrink by 3 to 5%. Firstly, due to unpredictability of the monsoon, which fortunately has now arrived, but there was a shift in the crop, and also the reduction in the area of acreage. Expected consumption is due to increase because of the restricted spread available between the man-made fiber and the cotton. But India is having a carryover stock of around 30%, which is almost 4 months equivalent of the consumption. If you really look at the recent past, the cotton prices have always railed under the MSP, and now it is in the stabilization mode with the intervention of the Cotton Corporation of India. CCI has acquired around 9 million bales, which is almost equivalent to 25% of the Indian crop size. The position which Chinese holding agency had acquired some 4 years back is now being acquired now by the CCI. If they dispose of the inventory below MSP, there is a possibility for exports to go up, and if they dispose it of below the, above the CA, if higher prices are offered, then exports of yarn will decline because the manufacturers would be comparatively uncompetitive as compared to the manufacturing in other parts of the world, predominantly China. The way we look at it, the monsoon cycle and the acreage data available with our internal analysis, we do not expect crop size to be impacted significantly in the next crop season. In the worst case scenario, CCI, whatever stock it has hoarded, would be depleted without impacting the carryover stock. The way the economy is behaving and the Make in India movement is taking place, we do not expect any correction to happen in the MSP. About Nandan Denim, we are the flagship of the Chidipal group. Based upon the last fiscal data, which are related to 13-14, Chidipal group is around 3,000 crore group, having presence in textiles, education, real estate, and polyfilms, the packaging films. The company or the group started way back in early 70s as a textile player. We have established inroads into the domestic market by establishing our network of the distribution. And today, if Nandan is the largest selling denim in the country, it is attributed to the efforts made by the promoters from day one. We have the ecosystem of the Chidipal group. We are present in processing of the fabric. We are present in the polyester yarn manufacturing. We are present in the cotton yarn manufacturing. We are present into the knitting. We are present into the weaving. We are present now into the denim. Essentially, the ecosystem is supporting each other unit. Though within the family, the distribution is each of the family members is in charge of one MBU, responsible for the outcome of the company's performance. But internally, the common knowledge, the common sharing that we have within the Chidipal family, that is supporting each other's business. If we look at the history of Nandan Denim, we started our manufacturing journey in 2004 with 6 million meters. Gradually, we have added denim manufacturing capacities after entering into spinning as well. As of today, we are balanced at around 100 million meters denim capacity, which is supposed to increase to 110 million meters. The spinning capacities are currently at around 64 tons a day, which are supposed to increase to 124 tons a day. We have established shirting capacity of around 10 million meters, which are not completely balanced. So we are still in the process of establishing the processing capacities. And we have also established a corresponding yarn dyeing capacity. Denim is generally being perceived as a commodity product. Well, there are two ways of looking at any of the products. Denim is the way the world shows its lifestyle. We can consider it as a commodity if we want to have it in place of maybe a lungi, but denim is a lifestyle statement. There are a lot of innovations happening. Some 10 years back, if we recollect, if we had bought 10 years back any of the denim fabrics, it used to weigh a lot. What we call technically as the rigid denim was the trend of that particular point of time. Obviously, the 50% of the Indian population belonging to the gender, feminine gender, they were not able to use a heavy fabric. Over the period of time, with the evolution of the technology, with the type of the R&D the companies have been doing, including Nandan, the 14.5 ounce fabric has been brought down to the level of around 4.5 ounce. This is all possible with the deployment of the latest manufacturing technology, continuous stress on the designs and the innovations, and making our product in line with the expectation or the quality parameters which are available anywhere in the world. Looking to the financials of the company, in the last 5 years, the company has grown its top line at a CAGR of 21%. EBITDA margins have grown at around 25%, and the PAT has grown at 31%. If you look at the margins analysis, at the EBITDA level, starting at 13%, in the last fiscal we have hit around 15%. At the PAT margin from 3%, we are closer to 5% range. Generally in the textile company, leveraging is an issue. We have been very conservative. Let me also mention at this point of time, our company is very closely held company, where promoters are hands-on involved into the company. As a matter of philosophy, promoters are not pro to the market risks. The underlying theory is, we will like to play a safe game. Margins may be not as high as could be possible in any other industry, but we do not want our company to be leveraged beyond a particular point that we cannot service the debt. And it is reflected in our financials. We are reasonably leveraged at 1.8. If you look at the returns, the return on equity has been around 20%, and ROC is now catching up at 16%. The capacity creation, some 5 years back we were at around 50 million meters capacity. Today we are at 100 million meters capacity. Capacity utilization is one of the driving forces, how we regulate our product designing, how we regulate our market conditions. We have been consistently increasing our capacity utilization, and there is a further scope for us to improve. On the spinning front, again we have added capacities, and we have constantly been utilizing our machines to the optimal level. On the realization front, we have taken some drastic measures in the recent past. We started into the denim industry basically as a mass marketing product. Initially, we were really not focusing on creation of value within the value chain. Gradually, in last 2 years, we have increased our focus, by way of which we are trying to have a larger share of our sales coming from the value-added product, and it is reflected the way our average sales realization is behaving over the period of last 3 years, from 112 rupees to 120 rupees to 132 rupees. But we know there is a lot of area to be covered. Looking to the market breakup, up till last year we were running short of the capacities, and therefore we were forced to go to the outsourcing of denim, realizing the heavy potential which the fabric offers. If you look at the current year number, we have 98.6% in-house manufacturing and around 1.4% by way of trading operations. If you look at the domestic and the international exposure of the sales, around 87% revenues were coming from the domestic market in the last fiscal, which are poised to further decline by way of increased share in the export market. Having said that it is a closely controlled company where the promoters are hands-on, there is another unique feature available within the company. On the board we have 7 directors, of which 2 are the promoter directors. Our group chairman Mr. VP Chidipal and our managing director Mr. Brajman Chidipal. But balance 5 persons are independent director. Let me also share with you about their credentials. Mr. T.S. Bhattacharya is ex-managing director of State Bank of India. Mr. Ambalal C. Patel is a retired bureaucrat from the Gujarat state government. Mr. Giraj Mohan is a marketing brand guru who has recently joined the board as an additional director. In this AGM he will be joining as a permanent director. He is the person who is now leading us on the front of creation of the brand. Then we have Mrs. Pratima Ram on our board. She is the ex-CEO of State Bank of India in the US and the African continent. Then we have Dr. Yashovardhan Verma, a management thinker, a philosopher and an HR expert, who was lastly the country head of LG India. And the last but not the least key person is Mr. Deepak Chidipal, the person who has created Nandan as it stands today and who is sitting here on the dais. One of the largest integrated denim manufacturing facility could not have been established at any other part of the country. Gujarat is the best place to be. We get around 70% of cotton from Gujarat. The way the state policies have been announced, which I would be detailing in the later part of the presentation, the state right now houses a significant part of the spinning capacities which are further going to be strengthened. Of course, right now we are following Tamil Nadu when it comes to the spinning capacities. And Ahmedabad is the major hub for the denim manufacture. You name any of the top manufacturers of the country, they are all headquartered at Ahmedabad. The current capacities are, we are having an open end spinning capacity of around 44 tons a day and 20 tons ring spinning capacity. The denim capacity is around 90 million meters and 10 million meters is for the shirting capacity. I referred about the textile policies applicable in the state of Gujarat. Karnataka, Maharashtra, Rajasthan and Madhya Pradesh. There is generally a central government scheme available for the textile upgradation fund, whereby interest subvention and capital subsidies are given for the investment into the textile. In the last TUFS announcement, which was announced somewhere in 2012, the central government had put a cap on the spinning investment, because the central government has a view that we have reasonably decent capacities for creation of the spinning. However, no specific cap had been put on the weaving and the processing capacities apart from the garmenting. Gujarat has been at a disadvantage when it comes to the textile scheme, because Gujarat is the biggest producer of cotton, and normally the entire cotton is exported outside India or outside Gujarat. So the Gujarat government had taken a view that we would like to put spinning as well on our priority. In turn came out another interest subvention offered by Gujarat government, that 7% subsidies are available for the spinning unit over and above the TUFs available under the central government, 6% for the technical textiles and 5% subvention for the other textile units. The Gujarat government also came out knowing it very well that Gujarat has uninterrupted powers available round the clock, but the power is slightly expensive. In order to make it a bit competitive, they have offered 1 rupee concession for all the power consumption that the new units consume for first 5 years. Then another interesting part, particularly for the fabric manufacturers, is the fabric manufacturers have 2 inputs. One is cotton, another is yarn. Both these products are subjected to VAT, but the fabric is not subjected to VAT, and therefore the set-off is not available. The Gujarat government came out with this philosophy that over the period of 8 years, we will set off the VAT element as long as the inputs are sourced from Gujarat. And then the textile park scheme, which is common. If you really compare the schemes offered by Gujarat, Maharashtra, Rajasthan and Madhya Pradesh, they are more or less competitive. But the advantage in favor of Gujarat is, of all the 4 states, financially Gujarat is a better state where the funds release is not going to be an issue. Gujarat also offers an additional feature of the infrastructure available. We have the best of the road connectivity, best of the ports available, best of the power availability, best of the pollution control measures initiated, best of the markets available in India, and the biggest requirement for the textile industry apart from the capital equipment is the manpower. Gujarat has been the textile hub for the country for centuries. You have abundance of requisite talented manpower available in the state. Now the company has undertaken an expansion plan. The total capital outlay is expected to be around 612 crore rupees. Around 250 crore will be invested in spinning, 250 crore will go into the creation of the denim capacity, and around 112 crore rupees will go in the yarn dyed shirting manufacturing. We have a very strong domestic and global demand for the denim. We have the locational advantage. We have the benefits available under the central TUFs and a special scheme of the state. Right now the state scheme is available only till 2017. It is due for renewal. We do not know what would be the new features. Nandan Denim already had its inroads created in the domestic market. Adding another capacity will provide it flexibility and the economies of scale to compete with any of the international players. Also, we had analyzed our financials with the competitors anywhere in the world. One of the major drawbacks which Nandan Denim was perceiving was we were not having control on our supply chain. We were sourcing a significant part of our yarn requirements from the spinners of the world. If we are able to control the yarn manufacturing, it will provide us 2-pronged advantage. One, we would be able to control on the delivery schedule, which is very much required when you are going to deal with the international brands. 2, the quality of the fabric would be controlled right from the inception stage, because at the stage of the yarn, if we are able to control the quality, the fabric quality is reasonably under control. The way we look at the expansion project is, with the investment coming into the picture, the turnover ratios would improve, which will strengthen our return ratios. To create a perspective, I think we have, in the recent past, we have interacted with most of you. If we manufacture a yarn, a particular coarser count yarn, the in-house manufacturing cost would be roughly 150 rupees a kg. Whereas if the same is sourced from the market, the price would be at least 25 rupees over and above that. Of course, the manufacturer will not be getting 25 rupees because there would be definitely be some outlays which the person would be making. This 25 rupees differential translates into roughly 12.5 rupees per meter of fabric, because normally the denim weighs around 500 grams and yarn is a major input. On a realization of 130 rupees where we are standing, 12.5 rupees means roughly 10% improvement in the returns ratio. Since we are already having 40% of our yarn manufacturing in-house, balance 60% is that which will entail us this additional benefit. From 10% it comes to 6%. That would be the EBITDA margin that we can add to our bottom line over the period of time. Currently our EBITDA is around 15%. On a very conservative basis, we are plotting it around in the range of 19.6 to 21.9%. Well, we have undertaken an expansion plan. The margins are expected to improve from 15% to minimum 20%. A higher ROCE, normally a concern of most of the guys sitting in the audience. ROCE is a challenge for a textile mill. We are right now at 15% and we are looking at 18 to 19% over the period of next 3 years. Return on equity, right now we are at around 21%, but with every improvement in the ROC, we are expecting a better ROE as well. This is all that I have in my presentation. Of course, safe harbor statement I am not going to read. Some of the expectations we have shared, and open this session for question answer. Thank you very much.
Thank you, Govindji. So basically, we'll open the floor for the Q&A. Anyone who has any questions can raise his hands, and we'll get the mic there, and we can have a Q&A.
Hello. Govindji, the top manufacturers who control about 1/3 of India's production also have some amount or a large amount of garmenting facility. As you were showing in that slide that if you are across the value chain, your realization is much higher. So using that same yardstick and the fact that we are doing some backward integration also for your yarn, are you looking at any sort of garmenting going forward?
As far as garmenting is, I would like to answer that. As far as garmenting is concerned, we have experienced that looking at Indian context, it is a very different ball game. It is not similar to fabric. We have tried our hands at garmenting in the past, but looking at the specifics of Indian requirements, the retailing in India is still not very organized. The quantum of orders is very, very small and more frequent. So looking at the nature of the Indian demand as far as garmenting is concerned, it's still some time to go for making it on a corporate level. So I think still we would like to wait for entering into garmenting industry. So, and as far as other manufacturers are concerned, barring only 2 players in the country, I do not see anyone who has entered into garmenting and made a success story. The only 2 players who have been successful is because of export market and because they are dealing with the good brands of the world. They are not catering to the Indian market.
Deepak, what I wanted to also know is that there are 2 parts to garmenting. One is manufacturing and selling as a retailer, and second is just doing manufacturing, because like you manufacture cloth, denim, and you give it to other people. Most of the brands in India don't have their own manufacturing facility. So purely as a outsourcing manufacturer of fabric to an outsourcing of garmenting for them?
Yeah, so you are correct. Manufacturing of garment is one story, and the branding and retailing is the other part of it. So when you talk about, say, two players, when you talk about Arvind and Raymond, Raymond is not into retailing, it is mainly into garmenting, manufacturing, and Arvind is both into manufacturing as well as the retailing. But they are two different divisions. You know, it is not like a backward integration. It is like a different vertical, this is different vertical, that is a different vertical. So each vertical has a different role to play. So sort of, I would not say technically they are backwardly integrated. So, but they are all different lines of businesses, you know, they all require different kind of specialization, different kind of mindset. So really they are not one business.
What's our current debt on the books? And on this expansion, how much have we already spent so far?
The current debt book is around 470 crore rupees as on 31st of March. At the peak level, we would be hitting around 650 crore. That would be lying in our books on March 2016.
Okay. Thanks.
Sir, three things. One, you have a 87% of your production for domestic market catering. That means your exports is 13%. And it appears that going forward you will be enhancing the export contribution more than the domestic. Should be in the range of 70-30 or 75-25. The second thing was you have a 650 crore expansion, which is in various phases of implementation. After this, what will be your denim capacity after the expansion? Because you have put 250 crores for denim.
In fact, the major portion of the 612 crores is denim only. We are in the 600 odd crores expansion plan. We are also venturing into the shirting, yarn dyed shirting product. So post expansion, our total capacity will stand at 120 million meters. 110 million meters will be for denim and 10 million meters will be for shirting, manufacturing shirting fabrics. What we believe is that going ahead, you know, cotton textiles will have a good future. These are new age products. These are not cotton shirtings. These are new age products. These have not been in India for decades. Post 2000, they have become popular, and coming generation, they will become more and more popular. So they have a good future, not only for Indian market, but also for export markets. So we have tried our hands at, you know, shirting, and also denim, the total capacity will stand at 110 million meters. Excellent. As far as the export and domestic ratio, what you mentioned, I could not understand your question. That is the status, that is the effort of the company is going to be towards export, that is correct. But what is your question? I didn't understand.
At the moment, your production 87% is domestic.
Yes, that is correct.
And 13% is export.
At the moment, yes.
Going forward, will export shift move up to say 25% or 30%?
That is what we plan to do, because if we understand the dynamics of Indian production, the production is increasing more than the demand. So on one hand, we can look at, you know, oversupply, but on the other hand, if you look at the world market, India has a significant role to play on the supply side. So even if we increase our production much more than the demand, domestic demand, there is also another market which is export market waiting for us. So what we believe is, if we target that market, then obviously we can insulate our you know, vagrancies in the demand side. So that is why, to balance the equation, we want that more focus has to be on the export front. Of course, domestic is not going to be neglected, but particular effort has to be made to make inroads in the export. So that's why we are targeting in next couple of years, our ratio between domestic and export should be around 70-30, 75-25 types.
That was what I had personally.
Yeah, that will also help us reduce the selling pressure and also move up the value chain.
Yes,
that is again one of the reasons why we are doing that.
Yeah, and recently Mr. Sanjay Lalbhai was interviewed on a business channel, and his face really fell when he was asked, how come the cotton prices have dropped so perceptibly? Because it seems Arvind carries almost 9-month consumption as inventory. And he admitted that yes, cotton prices have fallen and all of a sudden and without any notice. So for a short-term period, there will be pain for him because he is across the value chain. Seeing this price fall of cotton, don't you feel apart from your enhancing your yarn spinning capacity to improve your bottom line, cotton prices falling will also add to your bottom lines going forward?
I think for us it is a positive sign because falling raw material prices always make us more competitive. So obviously if the government is promoting higher MSPs, it is negative for a producer like us. And if the cotton prices are going down, it is giving us more strength, more competitiveness and more energy to export. So I think that is in our favor.
Yeah, and one last question. We were in a presentation by Raymond and they highlighted one thing, that denim when blended with lycra takes the shape of the human body, which is very well in demand for denim based jeans or other fabric garments abroad. Do you have any plans of denim being blended with other yarn so that you value add and the weight also goes down and the realization is up?
I think stretch, that is what we call as stretch denims, they have become the core now, they have become the basics now.
Correct.
It is no more like a value added product, it is no more like a new novel product for Indian consumption as well. Okay. If you look at Indian, particularly the female gender, I think 100% of the sales are happening with stretch. Nowadays, even what we are finding is even the male sector, 20% of our production in the male sector is also happening with stretch. Looking at the physique of Indian men, that is more comfortable.
Thank you and all the best.
I would just make a request before asking any questions. If you can also introduce yourself, that would be great.
This is Manish Ostal from Nirmal Bang. I have a question on your shirting business. Last year we have reported a revenue of around 116 crores from shirting business. So currently what is the utilization we have over there? And secondly, on export side, what is the per meter realization in denim?
As far as the shirting business is concerned, the entire, right now the company is under project stage. So modular expansion is happening, modular implementation of project is happening. So the entire capacity will be implemented only by March 2016. So by that time, as I said, the capacity would be about 10 million meters. Right now, looking at the market situation, we are able to produce about 5 million meters of shirting fabrics. Balance, the machines and the production capacity is being fully utilized. But as we add on, we'll keep on increasing the production capacity. As far as the export realizations are concerned, it is very similar to what we are finding. As far as the bottom lines are concerned, it is very similar to the realization that we get in domestic market. So I think export and domestic is quite similar in terms of profitability and in terms of realization.
Because last time you said that export will give better realization compared to what Arvind is reporting 160, 170, and currently we have a significant gap. So we are trying to moving or bridge that gap. So from that perspective, since your export revenue increased from 9% or to 12.5% this time, and you are continuously increasing that thing, so it should have an impact on the overall realization from that perspective.
As far as export market is concerned, there is no one market. We need to understand that export does not mean we are exporting one product and there is one buyer and it's all going to be same price and same profitability. There is a lot of diversity in it, and the reason why company is diversifying into export market is to help itself boost into in the future. So basically what we are trying to do is, as the capacity, Indian production capacity is increasing, we want to insulate ourselves from the variations or vagrancies in the demand and fashion shifts. So to overcome that situation, we are sort of preempting these kind of scenarios, and we are trying to balance the equation. That is the reason why we are going for more of exports. Secondly, we also want to move up the value chain in terms of making more fashion products and improving the realizations. So to reduce the supply pressure or sales pressure, we are diversifying the market base. That is the reason why we are going for exports. As far as exports profitability and realizations are concerned, it is very similar to, as of now, it is very similar to the domestic realizations. We have a lot of journey to cover, we have a lot of scope to improve, and going ahead, we will do it, and we are onto it.
So the 6% margin improvement what we are talking about is mainly because of what we have done on backward integration side. That is the primary factor for margin improvement, or export will not have any role in terms of margin?
That is going to be a mix of everything. It is going to be, of course, as the project is implemented, it is also going to give a lot of internal benefits to the company. Also, backward integration will have its own benefits. So that is one way it is going to help, number one. Number two, also as the project will be implemented, more and more benefits will come to the company, the government benefits. That will also help. And thirdly, we are also making more and more efforts to move up the value chain in terms of product categories. So that also will help. So everything put together, this we feel is a very conservative figure.
Lastly, I require two data points. One is what is the VAT reimbursement in FY15 and the capital subsidy, interest subsidy number for the full year?
I think 2015, you mean 14-15 or 15-16?
14-15
14-15 VAT reimbursement will not be eligible because only after commissioning the project will be eligible for that. So our commissioning date is March 16. So only after March 16 will be eligible for state benefits, which is the VAT benefit and interest subvention. So only after that will be eligible. So there is nothing which is accounted for in this year.
And interest subsidy?
Interest subsidy, as far as state subsidy is concerned, we have not accounted for it in this year. Only after commissioning of the entire project, which is 2016 March, will be eligible for that. Before that, it is only the central benefits.
Okay, thank you.
Any further questions? Yes, we have one there.
Hi, this is Ritesh Poladia, individual investor. I just want to know, as you said, denim fabric realization, the range is about 80 to 300 plus. So at what stage is it spinning, weaving or processing where the entire differential comes into play?
Entire differential?
In the cotton fabric also, it has a wide range, but the counts that makes a difference in the entire cotton fabric.
If you look at a garment, maybe two garments, weigh the same. Maybe they look the same, they feel the same, but one could be 1,000 rupees, the other could be 10,000 rupees. So what is the difference? It is a mix of everything. It is a mix of the yarn, it is the mix of color, it is the mix of styling, it is the mix of... So when we talk about value addition versus commodity fabrics, it is more to do with fashion introductions versus the fabric which is running year on year. So the fabric which is running year on year almost becomes like a commodity because there are many suppliers, so it tends to have lower prices vis-a-vis companies which are able to produce new introductions, does a lot of market research, does a lot of fashion products. They do not have a very longevity in terms of product life cycle, but they can fetch better realizations. So it starts from cotton, it starts from yarn, all the way it goes up to processing, because nowadays denims also require a lot of finishing treatments on the fabric stage, which erstwhile days it was not there. So nowadays a lot of value addition is happening on the finishing stage. So that also is making a lot of value addition.
So it is more of a processing side where now...
it is a mix of everything. I would say off late you can say it is processing, but it is every year or every 2 years the shift happens. So if you typically look at it, it will have say 1 or 2 years, it will be towards the yarn, then it will be towards the colors, then it will be towards the finishing treatments, then people are bored of it, then again it will switch to yarn, then it will probably come to styling of the garments, then it will come to wash. So garmenters and brands people have to keep it live to make it selling more. So it keeps on happening. That is the research, that is the market understanding which is required to get better realizations.
So Nandan denim is 100% cotton, or again it is blended?
No, it is, our endeavor is that as long as it is denim, we want to produce all kinds of fabrics. So if we look at the Indian market, a lot of denim in India which is sold today is having polyester content in it. There are various reasons for it, and I would say Nandan Denim is one of the biggest producers of India who is making denims with polyester content in it.
And as your average realization is about 130 odd rupees, could you share what would be the highest realization for you?
Our realization would be, highest realization could be around 200, 210 rupees.
Okay.
Could be 220 also.
Thank you, sir.
Hi, this is Abhishek here from IFL. I just in your presentation you spoke about an independent director who is really helping you and creating a brand and going ahead with it. So, what are the conscious effort which have been taken by you in putting yourself as a brand, and then how much of a realization improvement you are seeing through it?
When we talk about brand, we are not talking about brand in terms of consumers or people at large. What we are talking about building a brand is to the institutional or the business houses whom we are dealing with, or to the people whom we are in connection with, say investors, or it could be to our customers. So idea is to project ourselves as what we are to the external world. So the whole exercise is about that. It is not really to show something which we are not, but in fact to be more aware about this aspect of the business, whereby we need to be in connection with the outside world and we need to give importance about what we are, and needs to be projected accordingly to the external world. So I think primarily is handling this part of the equation.
Any further questions?
Hi sir, Jignesh from Niralban. I just want to check what earlier what kind of export incentive denim industry and we are witnessing, and right now is there any change in the export incentive from the government side?
As far as export incentive is concerned, government has reduced 2% drawback. So I would say this year from 1st of April, 1st of May, 1st of April, they have reduced 2% of export incentive. So earlier it used to be around 7 to 9% depending on what market we are exporting. So it has come down by around 2% on an average basis.
So to that extent the profitability in the export for the denim manufacturer has reduced, or we are able to take a price hike and compete with you?
Price rise is not really, this 2% does not get translated into a price rise because it's a local issue. It has got nothing to do with the international buyer. But international business is very complex in terms of there is a foreign exchange issue, there is also the cotton pricing issue, there is also the government benefit issue. So it's not really 1 or 2% will not really translate into any significant translation into prices as far as customer is concerned. So practically what we are observing is that trade happens on demand and supply. So if there is a poor demand, obviously we have to come down on price. If there is a good demand, we can always jack up the prices.
Let me brother, from I think 1st of the May there is no incentive from the government, 2% incentive has been reduced from the government. So if you compare on the month of May, May and June, margin for this 2 months and compared to YOY, margin for this 2 months on the export is reduced by at least 1 or 2%, or how is the scenario?
Because the cotton prices also have changed. Cotton exchange rate also has changed. So I would not say, and the selling prices also have changed. So everything, we are living in a dynamic world, so it's not the same, so everything keeps on changing month on month basis. So I would not say the profitability has come down. We are observing the same levels of profitability what we were observing 2 months, 3 months back.
And second thing, earlier we are mainly, you can say, buying yarn and then processing into denim. Now you can say post expansion we buying mainly cotton. And if you take out cotton is seasonal in nature, generally produced for 4 or 6 months only. Though it might be available for the full year, but then quality slightly deteriorate and pricing also vary. So it will change our working capital scenario, or how you can say once our expansion will be there, what will be our working capital cycle in terms of our inventory cycle or the receivable cycle? Post, you can say that.
As far as our working capital cycle or cotton coverage planning is concerned, in India, of course, anywhere in the world, arrivals happen only seasonally, but availability is there round the year. So there are two things. One is it is coming from the farms or it is coming from the warehouse. So as far as the availability is concerned, that is not an issue. Now as far as coverage is concerned, we at Nandan do not believe in a very long coverage. So we try to, if we are very bullish on the prices, then maybe we will increase the stocks by a month. If we are not, then we will go hand to mouth. So that is the policy. We do not go too long on working capital as a strategy, not for raw material, not for any kind of inventory. So our idea is to squeeze the inventory to the minimum level possible and let market drive the prices rather than work on the speculative gains or losses. So that is how we work.
Okay, thanks.
Sunil from Access Securities. Just one question, which is, we have grown significantly in terms of our capacities. What has been the trend in terms of increase in the debt as well? So the graph of maybe the increase in debt versus the increase in capacities over the last 10 years or 5 years, whatever number.
I think we have a chart here. He'll probably pull out the chart. But one thing is very clear, as far as textiles are concerned, debt is very reasonably cost debt finance.
That's a gearing of 1.8. So
Yes.
just being okay from 11.
It's less expensive.
So the increase in capacities FY11 to FY15.
By 2016, to put it in perspective,
Yeah,
by 2016 our debt will be, as you said, 650 crores.
Correct.
And leverage 2.1. 2.1 vis-a-vis our capacity of 120 million meters from 0 to whatever.
Okay, fine, thanks.
There is a question.
One small data point. In exports, which would be our top 3 countries where we are exporting?
Yeah, top 3 countries would be Latin America, Africa and Bangladesh. Market share, our market share? Should be more than 80%. More than 80% would be in these 3 areas.
Hello, this is Prashant from Mehta Equities. Can you throw some light on the top 10 customers domestically and in export, and with value if possible? Top 10 customers.
Yeah, top 10 as far as exports are concerned, right now we are focused more on wholesalers or local brands. So typically we would not be dealing with the direct brands, we would be dealing with the traders. So they are the people who are importing and then supplying it to the garmenters and then in turn supplying to the brands. So
you don't get direct orders from the brands?
No, we are dealing, we have started doing that, but it's not like that they are top 10 or something. For our revenue purpose, we have started dealing and we have started making sales in those segments also. So if you talk about known brands, if you want to know, then we have Polo, we have Calvin Klein, we have done some shipments with Target.
Direct or through some
No,
traders?
no, they do not buy direct because they are not interested in fabrics. So normally the shipment will go to either Indian exporter or Bangladesh or Africa or Indonesia or sometimes even China to get it converted into garments, and then it will in turn go to stores. Okay. So we are just the suppliers to the garmenters.
Okay.
Same is the equation in Indian scenario also. We are supplying to the garmenters who are in turn making garments and supplying to the brands. Because our product is not directly usable by the consumer. It is an industrial product.
Same case with killer jeans, you supply.
Yes. So, say if we talk about killer jeans or Spiker or any of such Indian brands, our fabric will go to our distributor. Distributor will in turn sell it to the garmenter of killer jeans, and that garmenter will in turn supply it to killer. So there is 3 people involved in after us who will really transact with killer.
So directly transacting with the brand should be difficult for you guys because you are the second largest denim manufacturer.
It will not be difficult. It is only a matter of time. Number one. Number two, as such, we are not making a product which is directly usable by the brand. So we can only have representation. Okay. But ultimately, it will be the garmenter who will be dealing with the brand. So okay. Normally, we make our representation. To give the idea about what is moving in the market. Then they would select the fabric. But ultimately, the transaction will not happen that way. The transaction will only happen through the garmenter or the trader.
Okay, sure. Thank you.
Any further questions? Fine, I believe we have one.
Vinay Nair from MK Global. Just wanted to get the max of the 612 crores of expansion. How much has been done? What has been the debt already which has been put into, and what is the kind of further debt we are taking? So, just imagine in the next one year, what will be the max of that 600 crores?
See, out of 612 crore capex plan that we have already invested almost 50% of it. Balance 50% we have already put the machines order, and civil construction is in the full swing. So machines delivery schedules are expected from September, October onwards. So we are expecting that the balance money would be spent from the Q3 through Q4. So by March, we hope to be done with 612 crore rupees. Funding is in 70-30 ratio. So around 430 crore is the borrowed funds, and the balance funds are from the internal accruals.
Any further questions? I believe I will just like to call Mr. Govind Sharda or Mr. Deepak Chiripal to have their closing comments, and post that I would invite all of you to have a high tea buffet which is just outside the banquet. Over to you, sir.
Thank you very much everyone for having shown interest in Nandan. We have been interacting with many of you for last 6 or 7 months. Though we come to share with you what the company is doing and what the company is planning to do, we have learnt a lot from you, and we intend to continue our learning. Once again, thank you very much. Thank you very much.